Hello, everyone. Welcome to today's webinar. Sensible Money's founder and CEO Dana Ansbach will talk us through the role of annuities in retirement planning. Dana is recognized as one of the nation's leading authorities on decumulation planning. She's the author of Control Your Retirement Destiny, the popular guide to decumulation planning. And you can also find this as a podcast on Apple, Spotify, and iTunes. Her popular online course, How to Plan for the Perfect Retirement, is available at thegreatcourses.com and at wondrium.com. And no surprise to any of us here, Sensible Money was this year named a best place to work for financial advisors by Investment News. I'm Nancy Fellinger, one of the financial planners here at Sensible Money, and I'm in Pawleys Island, South Carolina. Most of the team is based in Scottsdale, Arizona, but we also have team members in Massachusetts, Florida, Oregon, Indiana, and South Dakota. Having crossed over the $500 million in client assets management mark, last year we all gathered last week in Scottsdale, thankfully indoors. It was over 100 degrees for meetings and to celebrate this milestone. And with that, Dana, let's get started.
Thank you so much, Nancy. Well, let me start off with our favorite part, the disclosures. I want to make a point that I am not an insurance agent, and none of us here at Sensible Money are licensed agents. I have had insurance licenses in the past. Matter of fact, that's how my career started back in 1995, with a company where I had, insurance licenses and securities licenses. So despite the fact that I'm not an agent, I know an awful lot about insurance and annuities because we look at it from a financial planning lens. Our job is to figure out, is this product going to add value to your retirement income plan? But when it goes to actually implementing specific products, we work with agents. They have a level of knowledge and expertise about the particular products that they represent that goes far deeper than ours. And so when we get to the Q&A, we like to stay on and leave no question unanswered. But it may be that there's a certain level of detail to some of the questions that I will not be able to answer. When it comes to specific products and specific state regulations, I'm not going to know all of those. But that's why we work with agents when it gets down to that granular level of detail to make sure those questions do get answered. I also want to point out, we don't sell annuities. We don't participate in commissions from the sale of annuities. We have no affiliations and receive no incentives from any of the companies or products that we may mention. We may use examples. In many cases, I've tried to take out any specific names of products so that we're really talking conceptually today. So with all of that being said, let's get started. When we look at annuities, we're looking at them in terms of the overall retirement income plan. What are some strategies that can help make your money last longer? What's going to bring more peace of mind to your retirement income plan? What's going to be most tax efficient? Will adding a certain product or strategy help your money potentially last longer? Will it help protect you if you should live longer than average? Those are the types of things that we look at. And when you put this in perspective, on the right of the screen, you see portfolio paycheck. These might be withdrawals from savings and investments, mutual funds, bank savings, retirement accounts you've accumulated, Roth IRAs or 401ks. And on the left, you see guaranteed income. This could be a pension if you're lucky enough to have access to that. Social Security falls in this category. And this is where annuity income falls. And what we're really talking about is, do we want to take some assets from the right-hand side and move them into the left-hand bucket? So an IRA can own an annuity. A Roth can own an annuity. You could sell your mutual fund or trade your certificate of deposit in when it matures and buy an annuity. And so you're moving money from the right-hand side to the left-hand side. But ultimately, you have the same amount of acorns. We talk about working with people as they're at that point in time where they need to live off their acorns. And so the question is, does it add value? Should you move money from the right to the left? When might you do that? And how would you measure whether this is actually going to add value to you? Well, There's a few ways you could measure the effectiveness of an annuity, and I'm going to talk about some of those. Now, there's probably many more ways that people could come up with. So, I'm not considering this an exhaustive list. It's not, here's every possible way you could measure this, but here's a few. One is something we call the coverage ratio. So let me walk you through an example. Let's say your total expenses in retirement, all your outgoing cash flow, including income taxes, is estimated at $100,000 a year. You have guaranteed income, let's assume this comes from Social Security, of $37,000, and the rest of your needs need to come from that portfolio paycheck of $62,000. Well, your coverage ratio would be 37%. How much of your total expenses are covered by guaranteed income? And as you get later in life, we think it can make sense to have a higher coverage ratio. Now, that's not the only metric to look at, but it definitely helps bring peace of mind. If you were to be a victim of elder fraud, for example, if you have a higher coverage ratio, well, less of your wealth is going to be impacted. You're going to have this baseline of guaranteed income coming in. That brings us to the second metric. How do we measure that? Well, there's a measure we call fundedness, and it's very similar to what a pension plan does. So a pension plan will send out an annual notice, basically letting you know how well funded the plan is, meaning they have calculated out the liabilities, the checks that they need to deliver to all of the people who are eligible for benefits, and they measure that against the current assets. So I think of fundedness like horsepower, right? What is the job we're asking your financial portfolio to do? What is the workload that we've put on that financial portfolio? And so the higher the fundedness ratio, think of it like having more horsepower, right? You just got more room you could potentially spend more, or your risk of running out of money is really low if you have a high fundedness level or a lot more horsepower. So that's another way we can measure things. Then we could also look at what are your financial values at the end of your plan. And a lot of people will say, well, who cares if I have more money, right? When I'm 90 or 95. Now, maybe you do care because you want to pass a significant portion on to the next generation. But a lot of people would say, well, I'd rather spend more along the way. And those are really the same metric, right? So if I could look at a plan and I could say, well, you're estimated to have, 1.5 million remaining at age 90, or if we make this set of decisions, you're going to have 1.7 million. Well, then I could take that extra 200,000 and turn it into what does that mean in terms of additional spending that you could have along the way while ending up in the same place. And so when we look at financial assets, I have an example here. Let's say you have $1 million and we're looking at implementing an annuity with 100,000, and it's going to pay you $600 per month for life, or $7,200 a year. Well, after you put that annuity in place, you're going to have 900,000 of remaining assets. That's just today, right? A lot of people will say, oh, well, I don't want to do the annuity because what if I don't live that long? So you then have to project that out in time and say, yes, after you've implemented that annuity, you have 900,000 remaining liquid financial assets, but now those assets need to produce 7,200 a year less because that 7,200 a year is coming from this annuity. And when you project that over time, does that actually result in you having more assets at the end of the plan as if you had not implemented the annuity? So that's another way of measuring it. And then you can look at rate of return. Now, I don't think that's the right way to measure annuities because they do something that no other asset class does. They have a higher rate of return the longer you live, and we're going to look at that. And so there's simply no other asset class, Social Security actually, which I don't know if we would call that an asset class, but it works the same way. The longer you live, the higher the return on your Social Security benefits. And so simple rates of return, I don't believe are the right way. The truth is, we would have to know so many things that are impossible to know. First, we would have to compare that rate of return to what a portfolio could do. And we won't know that until we're looking in the rearview mirror. And second, we'd have to know exactly how long you're going to live. And so those are impossible things to know. But some people do like to look at the rate of return and try to compare that. Again, we're going to talk about why I don't think that's the right metric, but it is a way that you could measure annuity effectiveness. So let's look at these things in the context of the three main annuity types. 1, income annuities, 2, variable annuities, and 3, fixed annuities. Now, under each one of these are subtypes, and I could say it's 4 main types. I could say it's, 2 main types. There's all kinds of ways I could categorize this, but I had to pick a set of categories. So for example, under income annuities, we'll talk about deferred annuities and something called QLACs. Under fixed annuities, we'll talk about equity index annuities. Now, I've also attached some handouts, and because we're on a new version of GoToWebinar, I'm not exactly sure how you will get to them, but you may see a 3 dots with a more button and a little button called materials. And under there, you can download chapter 8 of my Control Your Retirement Destiny book, which solely covers annuities. And while it was written many years ago, in rereading it for this webinar, it's still all valid. It gives you a great overview of all of these different annuity types. So if you want to take a deep dive and learn more, that resource is available to you. So let's start by looking at income annuities. Well, in my book, I use this analogy of a cookie jar. So at its heart, an annuity is a contract with an insurance company that does one thing and one thing only really well: protects you from outliving your money. And so when I use the cookie jar analogy, I describe it as, let's say you put $100,000 into an immediate annuity where the income's going to start now. Well, picture this cookie jar as your $100,000, and you're going to pull your own cookies out of the jar each year to provide that cash flow that's coming in. What the insurance company has said is, hey, when your cookie jar runs empty, we will pull out of our own cookie jar to make sure your income continues for as long as you live. So at the heart of it, that is how an income annuity works. Now, you have deferred annuities where the income will start perhaps 5 to 10 years in the future. But it's really the same concept, right? You're giving the insurance company your jar of cookies. They're holding on to it and they're growing that jar of cookies. They're investing it for, let's say, 10 years. And they have made a promise that in 10 years, here's the monthly income they're going to pay to you. And first, you're just pulling cookies out of your own cookie jar. And then if that jar runs empty, they've said, hey, we will come out of our own pocket, out of our own cookie jar to keep paying you for life. And then there's a QLAC, a qualified longevity annuity contract. And typically there, the income starts much later in life, often about age 85. And all they really are is a deferred annuity. But there's special provisions that have allowed them to defer the required minimum distributions and have allowed you to purchase them within qualified retirement accounts. And it works the same way, right? You put your money in, you've said, here's $100,000, here's my cookie jar. And now they're saying, well, at age 85, we will pay you a significant amount of cookies each year. And again, they're coming out of your own cookie jar first. And if your cookie jar runs empty, then the insurance company comes out of its own pocket. Now, one of the things you'll often see with an income annuity is something called a payout rate. And it's important not to confuse that with a rate of return. So here we're going to look at an example. This is a female, age 66, and this is a quote we ran on blueprintincome.com. We said, well, if she puts $100,000 of qualified funds in an IRA to an immediate annuity, what will she get? And at the time, it said, well, she's going to get $622 per month. Now, there were different quotes, and the quote amounts are going to vary depending on the ratings of the underlying insurance company. And so I think in this case, we just took the highest one. Now, that may not be the right thing to do because you don't always want the highest payout amount if the ratings of the company are lower. So there would be much more digging to do before actually implementing this. But for the sake of running an analysis, here's where we started. And we said, okay, if she's going to get $7,464 a year, well, that's a payout rate, 7,464 divided by 100,000 of 7.4%. And sometimes you'll see annuities marketed that way, payout rate of 7.4%. And you think, wow, that's fantastic. But here's what the actual internal rate of return looks like. Now, question for you as we're looking at this: when does her cookie jar run empty? Any guesses? You're welcome to type an answer into the question box. When does this person's cookie jar run empty? And when do we switch over to the annuity company's cookie jar? Nope, not seeing any answers come in. So no brave souls out there.
Dana, here are a few.
Oh, for some reason I can't see them.
You have to go to the, I just figured this out. You have to go to the top.
Aha, I see them now.
Yeah. Yeah.
79. Okay, I see a lot of answers. 79, year 14. Pretty much yes, right? So this is a negative internal rate of return. And I have a little star here, internal rate of return. Rate of return is an annualized calculation, right? And so, if she passed away and this annuity had no return of principal, let's assume, she wanted the highest payout. And so she said, no return of principal, I want to maximize my current income. And she passed away a few years in. Well, she would have gotten 5 years worth of cash flow back and her internal rate of return would be negative. Basically, she's used up her own money right here around year 13 or 14. And now it's the insurance company's money that's coming out. And this is what I mean about the longer you live, the higher the internal rate of return. You can see that if she lives to 95, and that's a 30-year time frame, her internal rate of return is 6.3%, which is pretty good. That's actually quite an attractive internal rate of return. But you're not buying this for the internal rate of return. You're buying this because it does something that no other product does, right? It continues to pay if she lives to 107. And you might say, oh, that'll never happen to me. In this case, this particular person, her dad is 95. And so this is something that she's thinking about, right? Is wow, with the quality of healthcare and access to better healthcare, what happens if I do live to 100 or 103? And so we can see that the internal rate of return goes up the longer you live. Now, the other factor that comes up with these is, well, what about inflation, right? Clearly, if you're getting $7,464 a year 17 years from now, that's not going to buy the same amount of groceries as it will buy today. And so you can buy annuities, not always, but some companies will offer them that have some inflation adjustments in, but it's a trade-off, right? There is no free lunch. If they're going to increase this cash flow every year with inflation, you're going to start out with a much lower payout amount. If the annuity has a return of principal feature on it, there's going to be a lower payout amount. If it's going to pay out to a beneficiary for a set period of time, there's going to be a lower payout amount. So those are all trade-offs that you accept. Now, I think there's other ways to get inflation protection. I don't think this is the right place to do it, and we'll talk about that later on in today's webinar. Let's look at this same concept in terms of a QLAC. So QLAC, Qualified Longevity Annuity Contract. Here, same person, 100,000 qualified funds. This quote was run just a few days ago on Blueprint Income. We have no affiliation with them, just nice and convenient way to get some data to run these case studies. The annual payout at age 85 is $40,376. Wow, that's incredible. I put in $100,000 today and I get $40,000 in the future. Well, yes, but that's 20 years in the future, right? And so here, essentially, we have negative internal rates of return, and then that internal rate of return gets even higher if she lives longer. So this could be an option if she really thought she was going to live to 100 or 106. Well, perhaps this option would be an attractive way to go. Now, there's options where you can have a return of principal that comes back. So if you pass away in this time frame, then at least the 100,000 can go to an heir. There may be options, and I didn't dig into this right now, but I believe there are, where 100,000 would go to an heir with some fixed amount of interest. But again, as you start to layer on those options, it's going to then lower the amount of income that you get. So you have to be clear on the goal. I don't like it when people want one product to do everything. It's not going to work well, right? If your goal is a longevity hedge, this could be a fantastic product. Our thinking is you want as few bells and whistles as possible. If you're buying it for a longevity hedge, then you really want to maximize that income. This is the piece you're putting in place. It's insurance, right? You're insuring your income later on in old age. Now, let's look at how this might impact this trajectory. So in this case, we have this person, we're calling her Laura, and these different colors are different account types. So we have Laura's traditional retirement accounts. The yellow is her Roth, and the green is basically a non-retirement bucket. If she has no annuities, then beginning at age 71, 52% of her expected expenses are covered by guaranteed income. So we're looking at her coverage ratio now. And here's her expected spend down path. And here we're going out to age 91. So clearly she could live longer than that. If she were to implement 100,000 to an immediate annuity and 100,000 to a QLAC, well, beginning at age 85, she has 89% of her expected expenses covered by guaranteed income. And here's what her financial trajectory looks like. And it flattens off here later. So what we can see is what that strategy does is it protects a base level of income later in life. Her IRA was spent down much more quickly, but she has the Roth IRA remaining, and this is a much flatter line, so she's much less likely, well, she's not going to run out of money because 89% of her expected expenses are covered by guaranteed income. So this could be a good strategy for someone who's single, which this person is, and who was quite concerned about living past average and really wanted to make sure that they had something in place so that if that happens, their income is covered. Here's some things to know and watch out for. When you're looking at implementing income annuities, you can ladder into them over time. We, for the past 10 years, rarely implemented any income annuities because interest rates were low, and when we would run them in the financial plans, the metrics didn't look good. They weren't adding any value. But that's changed in the last year. And so as we're rerunning quotes, we find cases where they do add value. We also still find cases where they don't. But you can ladder into them over time so that you're not making a bet and putting all your money into one contract based on where interest rates are today. You can also take a wait and see approach. So we've had households that preferred the flexibility and optionality of having money invested in traditional markets, in stocks and bonds and mutual funds and CDs. And they didn't want their money tied up in a contract. And so what we said is, well, if you're constrained, if your assets should hit a minimum threshold amount, for some households that might be 500,000, for others it might be 1.5 million. But if you should spend down your assets more rapidly than expected and they hit this minimum threshold amount, at that point we should look at implementing an income annuity to put that layer of protection in. And other times it may be a triggering event. So this might be something you would consider if you should lose your spouse or partner. While you're joint and you have someone to split expenses with and joint sources of cash flow coming in, it may not make as much sense, but should you lose a spouse or partner, that may be the time to really evaluate it. You also need to consider the taxation. So if it's an IRA-owned annuity, the tax rules of the IRA apply. That's all you have to know, right? If it was tax deferred or tax deductible going in, it's all going to be taxable income coming out in a traditional IRA. If it's a Roth IRA, tax-free, the rules of that Roth IRA, the tax rules of that Roth will apply. So think of that IRA or Roth or 401k if it's a QLAC as a bucket, and inside that bucket you would put the annuity, and so the tax rules of the bucket are what's going to apply. But if it's funds that are non-qualified, then there's something called an exclusion ratio. And one of the things that you've done is taken investments that may have qualified for the more favorable qualified dividend and long-term capital gain tax rate, and you have converted them to ordinary income. Now, the exclusion ratio means simply with each payment that you receive, a portion of it's your own cookies coming back to you, right? That portion's not taxed, and a portion of it is considered interest, and that portion is taxed. And it's not a simple calculation. The insurance company will tell you what that exclusion ratio is, but the denominator of the exclusion ratio is the expected return of the contract. The insurance company has to calculate that. The numerator is the net investment. What did you put in? And life expectancy has to be factored in. What are the number of payments that are expected? And so all of those things go into the calculation to determine of each payment you receive, if it's non-qualified, what portion is taxed and what portion isn't. Now, there's other things to know. There are things called term certain. So term certain might mean I'm going to get an income for my life, and if I were to pass right away, I want to make sure cash flow goes out for at least 10 years. So that would be called a 10-year term certain. We talked about some annuities will have inflation adjustments, but the trade-off is going to be less income now. You can have survivor options. So you can have an annuity that pays out for your joint life if it's you and a spouse or you and a partner. And there's definitely return of principal options offered by some contracts. So you may say, well, if I pass away early, I want to know that this principal gets passed along to someone. There are rarely options that allow you to change your mind and cancel out of the contract, but some have those depending on the type of annuity. With income annuities, we don't see that as often, but sometimes you do see that. And in that case, there's usually hefty surrender charges. So if you change your mind in the first 10 years or 15 years, sometimes you'll see contracts structured a little differently where when we get into variable annuities, they may have much higher fees, but they may allow you to change your mind on a lower time frame. Now, I saw one question comes in around, would you ever recommend an IRA own an annuity? Absolutely. Matter of fact, often when we are doing this analysis and placing annuities, we will say, well, look, this amount of money is going to come out of your IRA anyway each year based on tax efficiency. So why not have this be an annuity, right? We haven't changed the tax characteristic of your plan at all. And I saw another question coming in on what makes an investment qualified. So we're not talking about, I think you're probably talking about a qualified dividend. So it really just has most, for example, S&P 500 stocks generate qualified dividends. I can't remember the technical classification of, why some dividends are considered qualified and some aren't. I could go look it up. You could probably Google it and it will tell you. So let's move on to variable annuities. Now, I use the image of a Swiss Army knife here because that's how I view them and not in a good way. I see variable annuities often being sold as if they're going to do everything. They're going to grow your money. They're going to provide a death benefit for your spouse. They're going to provide income for life. They have these riders on them called GMWBs, guaranteed minimum withdrawal benefits, or GMIBs, guaranteed minimum income benefits. And they're complicated. And I can tell you, nothing is going to do all of those things well. I think it could be really useful to carry a Swiss Army knife around in your purse or have one in the car in a jam. It might help you, get through something. But if you ever really need a screwdriver or really need a corkscrew or, whatever you might need, it's usually not going to be the best tool for the job. So let's look at why they can be so confusing. In my book, I talk about Wallet 1, which is real money, and Wallet 2, which is an accounting entry that's used to calculate a withdrawal amount. So this is a clip from a recent statement from a client we work with. And we can see that as of January 4th of this year, there was an accumulation value, $103,291. There was cash surrender value. There's no surrender charges, but it's this cash surrender value that would be what we call wallet money. Wallet 1, real money. So if you're going to walk away from the contract and say, I want out, it's this cash surrender value that you're going to get, but there's going to be taxation on that. So any gain in it is going to be taxed as ordinary income. But on a gross amount, this is what you get. And then there's a minimum guaranteed contract value. Well, what's that? Well, in this case, that's the actual death benefit. So, if you were to pass away right now, your heirs are going to get the full 103. But if the investments in this contract should go down for some reason severely, there is a minimum 84,000 that's guaranteed as a death benefit. Over here, you have Wallet 2. Well, what is this? Well, there's this rider on this, and it's a payout or withdrawal benefit. So you have this 155,235 number. Well, that is used to multiply by this annual withdrawal percentage that's contractually guaranteed by this rider in the contract to deliver $7,761 a year of guaranteed cash flow. Now, when you look at this contract, right, this $7,761 is guaranteed for life. If I divide that into the real money value, well, it's 7.5% of the accumulation base. So being able to take a 7.5% guaranteed income for life is really good. And so when we met this client many years ago, we had looked at this contract and said, well, it may not be something we would have recommended you buy, but now that you own it, it's worth more to you, and we'll talk about why this happens. It's worth more to you to keep it and use this guaranteed income benefit. Now, a second note about contracts. In this particular case, this insurance company had sold. So they had sold their book of business, or at least a part of their book of business, to another insurance company. So now there's a new name on the statement. And when we called to implement this income benefit, we said, you really want to turn this income stream on. They told us the maximum annual withdrawal percentage was 4.5%. But we knew based on the age of the client and based on reading the annuity contract that wasn't right. The actual annuity policy said it should be 5% based on their ages. And so they had to run a ticket, run it up the flagpole, and come back and tell us for some reason and who knows whether these things happen by accident or not, but in the transition of taking over the policies, the wrong percentage had gotten coded into their software. And so we were able to make sure that the client did in fact give this 5%. Now, when you talk about the complexities of annuities, here's another recent statement. This is as of March 28th, 2024. This is a small annuity contract, but look at all of these values. What person in the annuity company home office thinks that it makes sense to send someone this? I don't know. It makes no sense to me. No wonder they're so confusing, right? We have the current contract value of $328.24. Well, that's Wallet 1. That's real money. If this person walks away, that's what we get. But we also have this lifetime plus 2 value of $83,000. Well, that's Wallet 2. They can take an annual income based on this and based on a factor similar to the example that we saw before. And then we have this death benefit value down here. And that is the minimum amount that would get paid out. Now, keep in mind, if this person were to pass away right now, their heirs would get the contract value. But if the investments went down, all the death benefit value is saying is, hey, there's a minimum amount that would get paid out. So if the investments do horribly, this amount goes down. Now, in most cases, as you take withdrawals, this death benefit also goes down. There was a case many years ago where the way the contracts were written, that wasn't the case. So you could actually essentially deplete your annuity and still have a death benefit that was worth the full amount that you put in. The insurance companies figured that out, and those contracts, of course, were discontinued. But every once in a while, you come across someone that might own something like that has a very unique feature to it. And in that case, you go, wow, you should not cancel this contract. And so you have to be very careful as you're evaluating these if you already own one. The other factor that comes in with variable annuities are the fees. So this is an analysis we had done for a client that owned 3 annuity contracts. Here were 2 of them. So there's mortality and expense charges. We listed those out. Some contracts have an additional administrative expense. This is an annualized basis. Sometimes there's something that's just coded as other expenses. Then there's the average expense ratio of the mutual fund. So the reason it's called a variable annuity is the goal is, oh, you can put your money in here and you can invest in mutual fund-like options that are called separate accounts. And so you can still grow your money while having the protections and a minimum future guaranteed income that the insurance company is putting on there. And so you have this extra layer of mutual fund fees in there. Then there was a fee for the rider. In one case, it was this lifetime plus, and it was 80 basis points a year. And in another case, it was almost 1% a year for the income rider. Then there was an annual policy fee, which is pretty minimal, but $50 a year, one case, 30 in another. But just looking at these percentage-based fees, it's 3.4 on one, 3.6 on another. So imagine you buy one of these contracts and you put 100% of your money in equities. Now, some of them won't allow it. That's a whole nother discussion. But let's say they do. You put 100% of your money in equities and you have a pretty good run where the 15-year average return is 10%. Well, because of these fees, the most you're going to earn is about 6.5%. So what happens in many of these contracts is the fees erode the value to the point where you have to rely on the guarantees. And that's why we say, they may not be something we would recommend someone buy today, but if we come across clients that already own them, we have to look at this analysis and say, well, if you've owned it long enough and the fees have eroded the real money value to the point where you can't get the same amount of cash flow out of it as you could if you keep it and turn on these riders, well, in that case, you need to keep it and turn on these riders. So what to know and watch out for when we're talking about variable annuities? Well, a Swiss Army knife is never going to be great at anything. Just keep that in mind. Taxation. All gains come out first. This applies to distributions, including these, guaranteed lifetime withdrawal benefit, guaranteed minimum income benefit distributions from all types of deferred non-qualified annuities. We say non-qualified because keep in mind, if it's an IRA or Roth IRA that owns it, the tax treatment of that retirement account is what takes precedence. That determines how it will be taxed. So if it's non-qualified, then all gains are going to come out first. There's tax deferral. So oftentimes we'll say, well, you should, put this money in because you're going to get tax deferral. But again, if you are going to invest in mutual fund-like vehicles, stocks, bonds, mutual funds that own stocks that pay dividends, most of those are going to be qualified dividends, and they're going to be taxed at a favorable rate. And so you are taking that income that would be taxed at a lower rate and potentially making it taxed at a higher ordinary income tax rate. There are IRS penalty taxes imposed on pre-age 59 and a half withdrawals. Now that has nothing to do with the insurance company, right? If you own an insurance product, the reason it got eligible for tax deferral is it had to have the same type of penalty tax if you took early withdrawals that you see in IRAs or 401ks and other types of qualified retirement accounts. So the insurance company can't waive that. Sometimes you will see insurance companies that will say, well, we will allow you to take partial withdrawals that are exempt from surrender charges. And that may be the case, but it doesn't necessarily mean it's exempt. Well, it wouldn't be exempt from this IRS penalty tax. If you're over 59 and a half, you don't have to worry about it. And in addition, there's no step up in cost basis when you pass. So if I own stocks and mutual funds, let's say an S&P 500 index fund, and I pass away and I originally put $100,000 in it, and when I pass away, it's doubled in value and it's worth $200,000. Well, my heirs get that step up in cost basis, so they don't have to pay tax on that $100,000 of gain. No one ever pays tax on it. But if I put that same $100,000 in one of these variable annuity products and it actually does grow, it has low fees and it grows, and it's worth $200,000 when I pass, well, my heirs have to pay ordinary income tax on that distribution. And so they don't get that step up in cost basis. So there's, in my opinion, not super favorable tax rates. Now, because I'm a spreadsheet nut, probably about 10, 15 years ago, I ran a massive spreadsheet out that I could calculate out the exact tax treatment and figure out like how long did you have to own one of these products to make this tax deferral make sense. And you basically had to be in one of the highest tax brackets and own it for at least 25 years. I think that's what the analysis showed for the tax deferral to make sense. We talked about fees. Fees can be high. That will impact and perhaps make it so that you have to rely on the guarantees in the contract. Already own one? Evaluate carefully before exiting. As I mentioned, there's some contracts out there that have very unique features or very rich income riders that you can't buy in the open market today. And so you wouldn't want to casually exit out of one of those contracts. If you own an annuity within an IRA, well, you can roll it over to an IRA brokerage account. Now, again, you'd want to make sure you're out of any surrender charge time period, but it's a tax-free transfer, just like any IRA transfer or IRA rollover. Assuming you do it correctly, you could say, well, I'm going to take this opportunity to exit out of the annuity contract if it's not a good fit for me. If it's not an IRA, I really should have put this up under the tax treatment, but you're going to pay ordinary income tax on gain. You can't claim any losses. So if it goes down in value and you sell it in a mutual fund or a stock, you can claim the capital loss, but in an annuity contract, you can't. And you can 1035 exchange. So let's say you have an annuity that has high fees and or low fees in this case, and it has a substantial amount of gains in it. Well, you can exchange that for another annuity. You can even exchange it, a non-qualified annuity, into a long-term care product. So there's hybrid long-term care products. And so those are options you can explore if you're saying, wow, this product isn't a good fit, but if I cash it in, I'm going to pay an awful lot of taxes. Then that may be a time where you look at a 1035 exchange. There's also been cases where we had clients that had very high fee annuities, but they did have a lot of gains. It wasn't a good year to realize those gains. And so we were able to 1035 exchange into an annuity contract that had very low fees and at least say, okay, our plan is we're going to cash this in year one of retirement. That might be 5 years out from now. But in the meantime, we're going to kind of exchange it into a product that has really low fees so the investments can keep working within that contract as much as possible for you along the way. So it's a lot of stuff to cover. The last type of annuity we're going to talk about are fixed annuities. And I have a picture of a bank because they're most often equated to bank CDs. Now, you can Google this and find all kinds of great articles. Here's some of the differences. Bank CDs are FDIC insured. The interest income is taxed as earned. Fixed annuities are not FDIC insured. They're backed by the guarantees of the insurance company. The interest income is deferred until withdrawal. Bank CDs may have early withdrawal penalties with no partial withdrawals. Sometimes those penalties are only, you're forfeiting 1 quarter's worth of interest. Sometimes they're higher. With the fixed annuities, sometimes they will allow partial withdrawals that are exempt from the surrender charge. But if you're under age 59 and a half, you will be subject to the early withdrawal tax penalty on any gains in it. Bank CDs, administratively easy to include in an income ladder. So in a brokerage account, we can ladder out CDs and we can have them from different banks so that they're all under the FDIC insurance limit. With an annuity, it can be very administratively difficult to manage as part of an income ladder. You may want different companies to spread out your risk, and each one's going to have its own set of paperwork. Anytime you need to change bank accounts, change an address, change beneficiaries, anytime you need to get money out. So I have a story I'll tell about that that was very challenging. And so that's not always the case. Some companies are great, but other companies, it can be quite a challenge. So if you're up for that kind of challenge, they can at times offer attractive rates. Right now, when we're looking at 5-year fixed annuities, they're maybe about 1% more than the equivalent 5-year CD. Now, there's a second type of fixed annuity called a fixed equity index annuity. Now, this schedule comes out of my book, and it came from a particular research article. I tried to see if that research had been updated. I couldn't find it. So the reason we don't have the current timeframes is this is, an extensive piece of research that was done to say what's the fixed equity index annuity average return compared to the average return on 5-year CDs. And there's times where the annuity had the outperformance, and there's times where the CD had the outperformance. And this is why they're most often compared to CDs when you look at articles in the press. One of the challenges with the equity index annuities is there's additional complexities. There's things called cap rates and participation rates. So what an equity index annuity really is they're saying, okay, you give the insurance company your cookie jar, right, full of cookies, and they're going to tie the amount of interest you earn to a benchmark. So index is a benchmark. The S&P 500 is a benchmark that measures the performance of basically the largest 500 publicly traded stocks in the US. And so there's all kinds of different benchmarks that they can tie your interest rate to, but you'll most often see some kind of a stock index. Now, they will then have a cap. So if the index went up 10% and there was a 5% cap, well, you would get 5% interest credited. Or some of them will have, excuse my spelling error here, a participation rate. And so if the index went up 10% and there was a 40% participation rate, well, then you would get credited 4%. So this again can make these vehicles incredibly complex. Not only that, they can issue the contract with very attractive cap rates and participation rates and then change them over time. And we find that most people that own these products won't ever change the strategy that they're in. So within the contract, you can actually change strategies, but most people set it and forget it. And so meanwhile, the insurance company may have lowered the cap rate or lowered the participation rate. There may be a different option you could switch to that was more attractive, but there's really no one managing it. Oftentimes if it was a commission sold product, you're not even in touch with the person that you bought it from. And so there's no one looking at it each year and explaining the notifications that you get and what your options are. Now, this doesn't mean these are bad products. We've actually placed clients in these products before, but not for this growth. What you buy them for is just what you buy any annuity for, is a contractual guarantee. So here's an illustration we ran on a client earlier this year. We wanted to say, okay, what happens if we put $400,000 into this equity index annuity, and the income will start about 10 years from now, and they're going to get $50,000 a year guaranteed for life. Well, over here, we can see what's happening in terms of their cookie jar, right? So their cookie jar is running out of money. We have the contract's anniversary value. We have the cash surrender value here. So what will they get if they decided to change their mind and exit out of this annuity? Well, there is some remainder benefit in this case, even after they start taking this income out. But what you're really buying it for is this $50,000, right? You'll often see this income base touted, but that is not real money. That is wallet too. All that income base is used is to put into a formula that calculates this guaranteed amount that can come out. And so in this case, this was a pretty attractive product for the client in terms of buying it for the guarantees. However, they often come with these types of illustrations. And here we can see all of the complexity up here, the different strategies. Wow, we have strategies that have 155 participation rate. We have cap rates here at 7%. These have a high participation rate with no cap rate. And what if we allocated across all 4 of these strategies? And here this illustration goes, wow, now I could get $58,000 a year guaranteed for life because in this particular historical model, 92 to 22 is how it was run. Well, this income base would have grown more And in the Wallet 2 fake money calculation, it would have generated a higher guaranteed income amount. And wow, there's even a cash surrender value and available. So if I change my mind or cash it out, nope, 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 nope. Maybe this will come true. Maybe it won't. This isn't why you buy them. So if you're being shown these illustrations and you get all excited about, wow, this is a Swiss Army knife. Look, it does all of these things. I wouldn't count on it, right? You want to buy it for this. And if this is a good fit for your plan, fantastic, right? Then the product might be a good fit. If there's ever anything more than the basic, benefit amount that comes out of it, then that's gravy. But that's not the reason you buy these products. So what to know and watch out for? Well, you can ladder into fixed equity index annuities over time. You can also take the wait and see approach and all of the same things we talked about with income annuities. Taxation is going to be the same as we talked about with any non-qualified annuity, right? The interest income is tax deferred. It's first in, last, what am I getting? Yeah, first in, first out. So no, last in, first out. Why can't I remember that? I have to say it in the terms of all gain comes out first and is taxed as ordinary income. There we go. Tax deferral can be an advantage if your tax rate will be lower later, or it can be a disadvantage if your tax rate's going to be higher later. And we do see cases where retirees are in a higher tax rate later in retirement than they were early on. If it's IRA owned, the tax rules of the IRA will apply and no step up in cost basis when you pass. Some things to know. With fixed annuities, there can often be a teaser rate, and that teaser rate may step down after a specific period of time, or it may be lower upon renewal. So we've seen cases where there was an initial, great rate, and again, your renewal notice comes out, people don't necessarily pay attention to all those things that come in the mail, and it renewed, and now the annuity was paying 1 or 2%. This was back when interest rates were lower. So you got to watch out for that. Just what does MIGA stand for? You'll see that term. It's multi-year guarantee annuity. Paperwork is required to move to a new product, cash it in, take withdrawals. So I alluded to this example. So we had a client that had Pac Life annuities, IRA-owned annuities that had been put in place many years prior. And at the time, they were paying about a fixed rate of 3%. And this was when interest rates were 0. And so we thought, well, no way should we cash these in, right? A fixed rate of 3% in this interest rate environment is attractive. And so we used that annuity as part of what we call their income ladder. And so every year we were taking withdrawals from it, just like we would if we had CDs mature or bonds mature. But when we went to take one of the withdrawals, we started the process on September 27th, and it was nearly the end of December before we got the money. Our client service associate had to make weekly phone calls to the company. The company did not do the state tax withholding correctly, and no 1099-R was ever issued. Now, I have read contracts, and I remember one of our planners coming to me once who was reading through the fine print of a contract saying, wow, like this contract says that they can take up to 90 days to get your money. Is this true? And sometimes it is. And so most of the time, you're going to have companies that don't want to take that strategy, right? They're going to be customer service friendly. But you never know what kind of administration is going to come through or be running that insurance company when you need to get your money. And so it's something you need to be prepared for. It may not be as quick or as easily accessible as it would be if it were at the bank or if it were a CD owned in a brokerage account. And in cases of insurance company insolvency, your funds may be inaccessible for a while, so they can get tied up. Early on in my career, it was mid 90s. One of the first clients I worked with owned, I can't remember what the insurance company was, but they did have an annuity that they owned from an insurance company. This was when I lived in Colorado and was going through insolvency, and they did get their money back, all of their money back, but their money was tied up and inaccessible for about 2 years. Now, I believe nowadays, the state insurance companies, the state, I can't think of, guarantee associations, or there's a insurance board is what I'm trying to say, that come in and take over when this happens, are much faster than they were in the late 90s. But I have seen cases where the money became illiquid and you just couldn't access it for a while. So if you can't tell, I'm not a big fan of variable annuities, but income annuities, whether they're income that starts now or income that starts later, might fit into your plan if you or your spouse's family health and history indicates you might live longer than average, or you simply want to protect against living longer. If you have trouble sticking within your spending limits, if you have trouble sticking with an investment plan and an allocation model, if you have no other sources of guaranteed income other than Social Security, and if you're simply going to have greater peace of mind. If you go, wow, if this income's guaranteed and I don't have to think about it. Wade Pfau, in his retirement income style awareness questionnaire, talks about this in terms of the safety first. Oh, I have spelling errors all over, and I even ran spell check. So I don't know why I didn't catch those. But if you have safety first or a commitment type mindset, then this could be a good fit, but probably not for all your money. And we'll talk about that in a few more slides. A couple other miscellaneous things to talk about. Insurance company guarantees. So each contract is backed by the State Guarantee Association. It's not actually each contract, it's each household. And we had a question come in ahead of time, and I don't actually know the answer. And this is where I said, I'm not an insurance agent. So when we actually go to place contracts, these are the kinds of things that we work with the individual agent for. So for example, if you owned an annuity and your spouse owned an annuity, and your insurance company went under, and your state guarantee association protected the first 300,000, would that be per spouse or per household? Those are some things that we would need to look up. There is a link here where you can go click on your state and look up the limits. Now, I can tell you it has to do with the state where you signed the contract. So we have a client that has a house in Texas and another house in another state. And so when we were working to implement annuities, we were actually implementing $400,000 total. We were able to place $200,000 in one state while they were there. They had to sign the paperwork while they were in that state. And we were able to place $200,000 in a different state. And that way they have two different states, and both contracts were fully covered under each individual state's guarantee association limits. The question is, in a true Armageddon scenario, how good are those insurance company guarantees? And there's a second piece that someone emailed to us ahead of time. It's about reinsurers, and something that's been in the news quite a bit lately. And so under materials, it's the other PDF that you'll find. And I can't remember the actual title of it, but it's something along how did so much of our insurance company money end up in Bermuda is basically the gist of it. And it's a very interesting read when you go through and take a look at some of the insurance companies that were downgraded as a result of trying to basically offshore some of their risk. So the thing to remember is insurance companies have the same stuff to invest in that all of us have, right? Stocks, bonds, real estate, mutual funds, but they have much bigger pools of money and can make commitments for much longer time frames. So they could invest in real estate development projects that we would simply never be able to invest in, for example. But ultimately, in a true Armageddon situation, they could get into financial trouble just as easily as we could. And so, I do think there can be an attribute of taking advantage of mortality credits, which is the ability to protect you if you live long, something annuities do so well that no other vehicle does, that make it a good fit in many cases. But at the same time, you got to be aware, right? It's not the kind of thing where you'd say, oh, I'm going to just put all my money here and I'm going to be set. You also want to stick with highly rated companies, but be aware they can get downgraded. And so the higher the rating of the company, the more the regulators have looked at their financials and said, yes, this company's ability to meet its guarantees is solid. And that's going to be very important because you're already buying the insurance or the annuity contract because you want those guarantees. So you need to be as confident as possible that it's going to be able to meet those guarantees. You also need to be aware of RMD aggregation rules. So before the Secure Act, you could take qualified deferred income and traditional IRAs and qualified deferred income annuities. You basically, let's say we had an RMD that was coming out of a variable annuity, or a distribution that was coming out of a variable annuity. And you could aggregate this for your RMD calculation purpose. But if it was an immediate income annuity, it could not be aggregated. That immediate income annuity had to satisfy its own RMD, and then you had to calculate the RMDs on your other IRAs separately. Well, the Secure Act now allows for this aggregation. So it's just something you should know. You, in order to do it, have to get what's called the fair market value of your immediate annuity. And sometimes you will see statements, contract statements, that will have a fair market value calculation on there. Why would they do that? Because you could use that in your RMD calculation. And if you were getting more income from the income annuity, that could in turn mean you needed to take a lower RMD amount from other IRA accounts that you may have. All right. We're almost at time, and there's one or two other things I'm going to walk through. There's going to be a lot of numbers on this page, but looking at all of the metrics that we use, here we have Karen. Karen is age 57. We have a 34-year time horizon that we're initially running her plan. We can look at Karen's plan with no annuity, and we have these different metrics. Fundedness, meaning what's the workload that we're putting on her financial assets? And we want to see a fundedness ratio of 110% or better. Hers is 118. We have coverage ratio. How much of her total expenses at age 75, I like to take a snapshot out a little bit later in life, how much of her total expenses are covered by guaranteed income? 33%. After-tax nominal value. When we fast forward 34 years into the future, what are the financial assets that we expect Karen will have remaining? Well, 1.513. But nominal value means, in 34 years, 1.5 million is not going to be worth the same as 1.5 million today. So real value says in today's dollars, that's worth 570,000. I could then look at these same metrics if she implements $100,000 into an annuity. Her fundedness went up to 123%. So we took $100,000 out of her financial pool and moved it over to the guaranteed income bucket. So what is the workload that remains on the remaining amount of her financial assets? That's what this is measuring. And it's basically saying, wow, we have more horsepower. Coverage ratio, she has more guaranteed income. After tax nominal value went up, and then we have to translate that into today's real dollars. So did it increase her after-tax real dollars? Yeah, by $34,000, right? In terms of her net worth, that's a 4% increase. That's 34 years from now. It's not de minimis, but it's also not, it improves her situation, certainly. But it's not like, wow, this made all of the difference in the world, right? But a financial planner's job is to look at these things and have these conversations and say, okay, what are the things that are important to you? If Karen said, well, I don't care if I have an extra $34,000 of real dollars when I'm, 90 some years old, we could say, well, that could translate into an additional $1,000 a year of annual spending, approximately. Or Karen might just say, wow, I like the idea of having this additional coverage ratio. I like the idea of having at least a portion of my portfolio that's in place for longevity protection. Here's a second case, Brian and Sue, ages 66 and 58, $400,000 analysis if we're going to put this into an annuity or no annuity. And again, we see improvements in their fundedness ratio, in their coverage ratio, And now we had an increase in after-tax real dollars at the end of the plan 32 years from now of $162,000, which could translate into an additional $5,000 a year of spending. In terms of their net worth translated back into real today's dollars, their net worth at the end of the plan would be in today's dollars measured at about 3.2. So it could make an impact if they live long of about 5% of their total net worth. And then we had Jeff and Heidi. And Jeff and Heidi were younger and their metrics weren't really changed. There wasn't a big impact on whether we implemented the annuity or not. There's other cases we've run where the impact was negative. It actually wouldn't make sense. And it's going to depend on all kinds of factors like our time frame, how old they are, the ratio of assets that they have in qualified versus non-qualified, what type of annuity we're placing. In this case, Jeff and Heidi actually went ahead with the annuity because they have some concerns about Heidi being very long-lived and making sure that she has a good baseline of guaranteed income. So even so the metrics were not super compelling, there's other factors beyond just the math that ought to be considered in terms of what brings someone peace of mind. Now, last thought, and then we'll open it up to Q&A. For those of us who have the retirement management advisor designation, we're taught to think of allocation a little differently, and we often use something called a household balance sheet. So here we are taking current assets, real estate, and financial capital, and income ladder in our case would be CDs or bonds, and the present value of income streams. So this person is expected to work another probably 7 to 10 years. And so their human capital, if I turn it into a present value balance sheet, is contributing 1.7, almost 1.8 million to their lifetime household balance sheet. Social Security, which they haven't started, but in present value terms, it's worth about $793,000. And if we implement an annuity in present value terms, it's worth about $191,000. Now over here on the right, we can see their expenses over their whole lifetime turned into a present value number. Here's the liabilities. They'll spend about $715,000 on housing, about $1.7 million on base living expenses. We have future auto purchases. Discretionary is primarily travel. And we have healthcare related, and then 1.1 million in present value terms on income taxes, or 26% of their lifetime expenditures are expected to go to income taxes. In this term, by the way, healthcare includes Medicare Part B, out-of-pocket, and insurance premiums. Well, we can look at this in terms of allocation. So what percentage of their assets are allocated to inflation protection, for example? I'll give you guys a minute to think about it. What percentage of their household balance sheet is allocated to inflation protection? Well, we would say Social Security and their financial capital investments that are invested for upside in growth investments. So investing in broad stock market related index funds has proven to be a good inflation hedge. Social Security has an inflation adjustment in it. So when I add up these two things, when I look at their household income, 44% is already allocated in a way that will help them keep up with inflation. What percentage is allocated to what we call lifetime flooring or a longevity hedge? Well, 23%. It would be Social Security and the annuity. So we have 23% of their assets allocated toward protecting them if they should live long. What's her biggest risk? Well, it's losing this human capital. In this case, if this person, were to lose their job early and not be able to find a comparable income, if a health event came along, that's going to be the biggest risk to their plan. So this is a different way of looking at how you allocate to cover particular risks that you're facing in retirement. And here's one more example. So in this case, this person has substantial real estate assets. This is what they're worth today, and a pretty good sized portfolio. So their total financial portfolio would be these two numbers combined, 40% invested in for upside and growth and 1.4 million in laddered CDs and bonds. They're not working anymore. They have, between the two of them, a present value Social Security at 1.8 million. And if we implement annuities, that's going to add, in present value terms, about 811,000. So again, you can look and say, well, what percentage of their assets are allocated to protect them against inflation? Well, 55%, this upside and this Social Security. And what percentage are allocated to protect against lifetime flooring, against living long? Well, 22%, this Social Security and this annuity. So what's their biggest risk? Well, with this amount invested in upside in the real estate market, it would really be a prolonged or sustained bear market combined with the housing collapse, right? That would be their biggest risk in terms of their wealth and their ability to sustain the lifestyle they want. So it's a different way of looking at it. Instead of starting with the end product, we really start around, do we have an income plan that offers a reasonable amount of your assets that are allocated toward protecting against inflation, and a reasonable amount of your assets that are allocated toward lifetime income. And somebody that might have a lot of Social Security or pension income already may not need to look at an annuity. Or somebody that has so much in assets relative to their level of spending, it may not make sense for them to add that annuity in. But for other households that have only Social Security as guaranteed income, they may need to say, you know what, we need to allocate a bit more of our assets to providing lifetime income. So we ran over, of course, because this was so much to cover. We're going to open it up to Q&A. I know Nancy's going to help me. We'll try to get all our questions answered. And if we can't, we'll do our best to follow up with you.
Okay, Dana, there are several questions. Let me start with someone was asking if you would talk more about the multi-year guaranteed annuities.
Yeah, it's very similar to a CD, right? So if you buy a 5-year CD, you have a set interest rate that you get, and that CD matures in 5 years, and then you decide what you want to do with it. So with a multi-year guaranteed annuity, it usually has a fixed interest rate for a specific amount of time. The interest income on it's going to be deferred. So with the CD, you're going to get a 1099 each year, and you report the interest income on your tax return. With the multi-year guarantee annuity, you're not going to get a 1099 each year, but at the end of that 5 years, you cash it in. Then all of that interest income that had been accumulated, you would pay tax on it at once, or you would roll it into a new annuity contract, or at the end of that guaranteed interest rate period, there may be a lower interest rate or higher, you don't know, that the insurance company is offering. And so you would have to decide what to do with it at the end of that term.
Okay, there's been a question about the state coverage for the guarantee fund, and we know whether it's by person, by couple, per annuity, and it really comes down to talking to the state.
Yeah, and I probably confused things. So, yes, my understanding is it is per contract, but what I was trying to say is, let's say I buy a contract in my name and my spouse also buys a contract in their name, right? And so that's what I was referring to. If I have a joint contract, my and my spouse own a contract jointly, my understanding is it is that contract limit. So if my state covers 300,000, our contract is 300,000. But could it be that I could buy one for 300 and my spouse could buy one for 300,000? Now we have two separate contracts owned separately. So those are things that you can work through when you're working with an individual agent. As I talked about in a case that we worked through, we were able to put both were joint contracts. One was in one state, one was in another. And so there's just, those are things that I'm not going to have all of the answers to, but they're questions that do come up when we get to the specifics of implementation. There could be numerous other reasons why you would not want to title the annuity individually rather than as a couple.
Mm-hmm. Yeah, bottom line is that because every state is different, you have to just know the state you're in, or the state you're concerned about.
Yeah.
Know what those rules are. A thoughtful question regarding the trade-off. So this questioner says, what I struggle with is the trade-off of market returns versus below market returns annuities promise. There is no free lunch, right? So I think this is referring to, markets. In good markets, there may be a little bit of a drag, but in not good markets, the annuity may hold up with some sort of a guaranteed income. As I think how that reads.
Yeah, I mean, that's always the trade-off, right? If we want the potential to earn higher returns, then annuities is not going to be it, right? It has a contractually guaranteed term in it. And so that's why we like the concept of diversification, right? Some people weigh more toward plans that have flexibility and optionality, and they prefer that probability-based approach. And so a market-based portfolio is going to be for them. I'll give you an example. We cover near-term withdrawals typically by using a CD or a bond ladder. Now, I had a client, we were on a joint call with one of our planners yesterday, and so the growth portfolio has grown quite a bit. We've had good market returns, right, in the last few years. And so we were talking about, should we sell some of that growth and put it into additional CDs or bonds that are going to mature? And what was their preference? Was their preference that we just cover 1 year's worth of future income, and leave, more of the portfolio in growth? Or was their preference that we be a little more aggressive and take risk off the table? And their preference was that we be more aggressive and not take as much risk off the table. So they said, yeah, we want to sell a little bit of growth and cover maybe one additional year of income in this bond ladder, but we're okay with the volatility of the markets, right? We're comfortable with that. And that is a personal preference, right? There isn't a right or wrong answer. From a planning perspective, having gone through the Great Recession with clients who had just retired, if you don't have some level of protection in place, it can be terrifying. And it's easy to forget that now. We had the bear market of 2020 with COVID, but that didn't really count because there was this external event. So it's been quite a long time now since we've really had a severe bear market. When it happens, it can be terrifying if you just retired. And so that's where you have to find that individual balance, or work with a financial planner or retirement income planner to find that balance of how much that you want for probability-based upside and how much do you want to protect a minimum outcome.
Yeah. Question on on the commission end of annuities. So how does one learn the way that the seller is earning their part, or earning their commission? Are they single sale commission or longer term payouts, which would be the trailers, like some lump sum amount up front and then the trailer? Which is better for the buyer?
The only way I know you would find out is to ask and hopefully, get a straight answer. If you're not getting a straight answer, maybe you want to work with someone who does. We have both an agent we have a relationship with that sells commission products, and we have resources to sell non-commission products. And amazingly enough, sometimes the commission product is the better of the two. So just because something has a commission doesn't mean it's a bad product. The insurance company, in some cases, will pay that person up front. And usually, if there's a significant surrender charge on the contract, that means there was a pretty hefty upfront commission, because the insurance company is basically saying, hey, we paid the person that sold you this, and if you change your mind 2 years from now, we have to have a way to recoup those commissions that we paid out. And typically you'll see that if there are not big surrender charges, instead you will have higher ongoing fees within the contract. And so in that case, the person that sold it to you may be receiving what's called a trailer or some kind of a revenue sharing agreement each and every year. Now, the trade-off is, if you change your mind a few years in, you don't have any surrender charges. Great. So you have a little more flexibility. But over time, if you actually owned this product for life, you could end up paying more that way. And so it's really impossible to say which one is best, right? It all depends on your goals and objectives and the individual contract. You have to read through and examine this stuff to figure out what is actually going on.
Yeah. Ask, and if you're not getting a straight answer, it's should be at least a beige flag, I think. How do you measure how well your financial plan is funded?
So we use several measures. One of them is fundedness. And what fundedness is we have projected out the withdrawals that need to come from the portfolio paycheck funnel. And we've projected those out over someone's lifetime. Then we've discounted it back into today's dollars and compared that to the amount of financial assets they have. So that's what that fundedness ratio is. And we want to see a ratio of 110%, meaning what you have today is valued at 110% of what it would take to cover things for life. And so that is one of the ways that we measure it. Then you've got another way of measuring it, which would be a Monte Carlo scenario, right? And so now you're testing somebody's assets over various potential patterns of return. So if we got a big market downturn, what's going to happen, right? Would you still be okay? There's other ways of testing it, which is something called a historical audit. And we use that too. And that basically says, hey, if we had done this in the past and you retired in 1927, 1928, 1929, right? Would your money have lasted? And so you can go back and basically put yourself back in time and try to figure out like if that plan had worked. And so we like to use all of these different measures. Each one has its pro and its con, but by using all three and then measuring them over time, we can see, are these metrics improving? Are they staying the same? Are they getting worse? And so that's a long answer to, how do you tell if your plan is well funded? That's how we do it.
Very thoroughly. So along those lines, Dana, could you say more about fundedness? I understand it conceptually, but didn't understand the 123% versus 118% in the table for Karen. So how is fundedness computed?
So I think I just explained that, right? We take the withdrawals that you're going to have to take from your financial assets. We discount them back to, what would you need in today's dollars to meet that lifetime stream of withdrawals. And we compare that to the financial assets that you have today. So in the case of the 118 versus I believe it was 123, right? We were taking $100,000 out of the financial portfolio, but the financial portfolio now also needed to deliver less income because the annuity was providing the income. And so when we recalculated fundedness after having put this annuity in place, the remaining withdrawals that the financial portfolio had to support were lower relative to the amount of assets. And so her fundedness ratio improved. That may sound really complicated. When we work with clients, we don't necessarily go into all these details. Some of them love it, but some of them were just like, hey, you want this number to be higher, and it is, so good.
Would it make sense to use a 10-year fixed annuity if someone wants to retire early and wants to create an income stream from 60 years old until taking Social Security at 70?
Possibly. So there's definitely, period certain annuities. I don't think we got to that term, but right. What we see is that most of the time, the amount of cash flow someone needs from their portfolio isn't linear, right? So I could say, great, I need $20,000 a year for the next 10 years. But in reality, we find, people have children getting married or trips they're taking or, house repairs. And so their cash flows are not linear. And so there could be a baseline amount where you go, if I have this baseline amount of income, I'm going to cover that with a period certain annuity. That's going to cover the gap until I get to Social Security. And I think that could be a great solution.
All right. So this question was actually asked earlier, and we want clarification here. So, would you ever recommend buying an immediate income annuity in a Roth IRA?
Well, I never have. That doesn't mean I never would, because, I always am a fan of, you have to run the analysis and see what it says. But in general, you want all your growth assets in a Roth IRA, and that's going to grow tax free. And oftentimes they're the best asset to use later in retirement. And so as of, now, I have never come across a situation where that was the best place to put an immediate annuity when we were implementing them. But I wouldn't say that I would never do it. It's unlikely, but I'm sure there are some situations or households out there where I might look at it and go, yeah, actually, this makes sense.
Yeah. So, and my apologies if you already answered this. I'm still getting used to this new setup. Is Blueprint a secure, legit firm to do business with? And is there any advantage in dealing with Blueprint or going with a local agent? And this was actually responded to by Bob, I can see now.
Okay, Blueprint is owned by Mass Mutual, and Mass Mutual is definitely a reputable and highly rated company. In terms of going with a local agent, I don't know, because some agents are very limited. In order to sell an insurance company product, you have to be appointed with that insurance company. And so when someone is an agent, doesn't mean they can represent all products. And so, you could get someone who says, oh, well, here's the 3 companies I'm contracted with, and that's all they have. And it could be that a different product would be better for you. And so it's very difficult to answer that. It's also impossible to actually go out and get almost every single option that's out there and compare them all at once. And by the time you would do that, a few weeks would have gone by and it would have changed. So the company with the best rating and the best payout one week might be different than the company with the best rating and the best payout next week. When you're looking at the best options, they're all going to be really close. But the best thing you can do is find someone who has a lot of options available to them. They're not beholden to just a few companies, has been in business for quite some time. And, in my view, the challenge from a financial planning standpoint is, if all someone does is sell annuities, then they're going to tell you that's what you need. And so, we place annuities. I've placed 4 this year as part of my financial planning, because it fit the client's plan. Right? We hadn't looked at them for a long time, and now we're starting to, with interest rates, look at them. And so it's just a more objective process. So obviously I'm biased. I'm a fan of doing it from a financial planning process versus going out and doing it from a product approach.
Yep. And there was a question earlier about qualified money in general, and the distinction really is, if you have an IRA, the annuity is the investment vehicle. It's still an IRA. It's still, still pre-tax. It's still ordinary income as it comes out. And the non-qualified would be the purchase with after-tax dollars. And that's where you get into your first in, first out. I always have to do that too. Like, what comes out first? What criteria would you use when selecting a company for an income annuity?
What criteria would I use? Well, I would definitely look at ratings, right? So you're going to want to look at highly rated companies, because, as I said before, you want to know the company's going to be around, right? What's their ability to fulfill these contractual guarantees? And then you're looking at, does it, within companies similarly rated, what are the payouts and terms of the contract relative to other companies with similar ratings? So those would really be the 2 things.
Question, Dana, regarding charitable annuities. So this would involve actually going to the organization and purchasing an annuity through them. So the question is, what about purchasing annuities through charities such as the Nature Conservancy? They have a variety, and they may be more solvent than some annuity companies. What are the pros and cons here?
I don't know if there's a rating system for charities or endowments or foundations. I've definitely seen people purchase annuities. Usually, it's from somewhere they went to college, and so they will go back and want to contribute, and they get an income for life. They get a charitable deduction when they contribute to that charity or that endowment or that foundation. And so the advantage would be you get a deduction that you don't get with just buying an annuity from an insurance company. The disadvantage is now you're relying on that foundation or charity, you're relying on their guarantees, right? So is it possible they could get mismanaged one day, or something could happen and they're not able to fulfill their terms of their contract?
I've been reading about different kinds of annuities, but haven't found much guidance on the proper amount. I want you to cover at least your basic expenses. I know you want to cover at least your basic expenses, and we all have expenses beyond basic. Does it make sense to cover all your expenses? Similarly, how do you know if you are over annuitizing?
There is not, I know you guys hate these answers, but there isn't a right or wrong answer to these questions, right? We use a very rough ratio. If less than 50% of your expenses are covered by guaranteed income once you're age 70 plus and claiming Social Security, then maybe a conversation around annuitizing at least some of your assets is worth having. And when we have those conversations, some people are, as we call it, very overfunded. The amount of assets they have relative to what they're spending is significant. And so they may be very comfortable with market risk and say, oh, no, I get it. I've got my Social Security and, I'm comfortable with that. Other clients may say, you know what? I have so much more peace of mind, and I'm so much more relaxed, and I feel like I can spend more knowing that I have this guaranteed income coming in. And then the conversation goes entirely differently. And then our job is to run the kind of metrics that you've seen, figure out, well, what kind of account should we purchase the annuity in? What are the tax implications of it? How does it change the plan? When should the income start? Does it really add value to the plan? So we work with people to determine that, and the answers are all over the place. I've had people that I really thought should purchase annuities because they were overspenders, and I was very worried that they would run out of money later in life, but they absolutely wouldn't even consider it. And I've had others who were so overfunded, they have so much in assets, relative to their withdrawal needs, that it was like, well, this product doesn't really make sense for you, because your potential to earn more in the markets is so much greater. But they just wanted the peace of mind. And so I wish there was a nice simple answer to give you on that. I do like the concept of saying, okay, when you're looking at, as we did with that household balance sheet, what percentage of your assets offer inflation protection? Somewhere between 40 and 50% is great. What percentage of your assets offer lifetime income protection? I'd like to see somewhere at least at around 25%. And so there are ways that you can look at that and see where you're at.
There was a question, Dana, about long-term care coverage, and before I look for that one, here's one about income annuities and bond ladders. So I've often seen income annuities compared with bond ladders. The latter, L-A-T-T-E-R, pun intended, offers flexibility and keeping assets on your balance sheet, but the former seems less expensive to pay a low purchase fee once versus an annual fee for maintaining the bond ladder, and you can outlive the bond ladder income payout while the income annuity lasts as long as you do with the mortality credits. If you take life only payout or maintain inheritance to heirs if opt for cash refund, how do you see this comparison shaking out?
So I'm going to go back to this household balance sheet, because this is where it's like, I don't know why we're comparing them. They're different things, right? Mm-hmm. So in this household balance sheet here, we have, an allocation to both, right? We have a financial portfolio that is financial capital upside. We do have a traditional bond ladder, and we have allocations to an annuity. And in a way, you allocate more to Social Security by delaying, or at least by the highest earner delaying. And so they don't have to be an either or, nor do I think they should be, right? They're doing very different things. An annuity is providing income for life. It protects you if you live long, but there's no optionality. There's no flexibility. A bond ladder has all the optionality and flexibility, you need. You can change the spending amount. When the bond matures, you don't need that much income. You can reinvest it. If you need more income, we can sell the bond earlier. We can sell from some of the growth portfolio. So in my opinion, you need both. Rather, or not everybody needs both, but I wouldn't look at it as an either or, right? I would look at it as they do different things. So what are the characteristics you're looking for? What are the risks you want to hedge? And in our opinion, the best strategy has allocations across all of these types of things, right? Not just across one of them.
Do you need to spread annuities across different insurance companies? And how does company quality impact that decision?
Well, you can, and oftentimes people do, and I think it's a wise move. So when we talked about when an insurance company becomes insolvent, your money could be frozen for a bit. And so in many cases, people will spread out their annuity purchases across different companies and across different time horizons, right? Not necessarily buying them all at once, maybe one this year, maybe one next calendar year, depending on where interest rates are or which kind of terms the insurance company is offering. So, I definitely think it can make sense to spread them out. Again, if you're dealing with a high quality, top rated company, then maybe that's not necessary.
Any reason to have individual annuities for each spouse versus joint spousal annuity? Is there, and I think that they're asking this because big age difference between the spouses, or maybe it's that, would that be a reason to do so? But if there's an age difference between spouses.
Yeah. So I've actually run that analysis before. So, I've had clients that come in, I've had clients where we ran 50 versions of their plan for them because, we were examining every possible option like this. And I don't know without running it, right? You'd have to get the quotes for joint, you'd have to get the quotes for individual, and then you'd have to talk about longevity and the pros and the cons of each. There have been cases where, we have in cases where people were claiming their pension in the form of an annuity, where we have looked at one spouse that was less healthy and older and said, well, you absolutely need to take the 100% survivor option. And we might have had a younger spouse that was quite healthy where we said, looking at the odds, you can choose the life only option. And so it's circumstantial, it's going to depend on your individual circumstances to determine those answers.
Oh. I wish this were so. The question is, any annuities within IRAs or Roth IRAs that can optionally keep distributions from the annuity within the IRA or Roth IRA instead of automatically distributing the money to checking accounts? So could we recycle within an annuity? Yeah. No.
So it depends, right? If you have required minimum distributions, those have to come out of that IRA contract. And no, I don't know of any that would then allow you to put it into a non-qualified, because that would be a new contract that you would be buying.
Well, I think they're talking about, I'm sorry, Dana, I think the question really is within the IRA. So if you've got it in an IRA, can you have whatever the distribution is kind of stay within the IRA, so it sort of comes out, but it goes back in, or it doesn't come, in other words, it doesn't come out of the IRA product? I think the answer there is clearly no. You got to take the
Well,
distribution.
I mean, you can do IRA transfers or rollovers, right? So
Mm-hmm.
if you owned an annuity IRA and you wanted to do a partial surrender and move some of the money via transfer to an IRA brokerage account, you could. But if that annuity has already been annuitized, meaning it's already paying out an income stream, then I don't know. You'd have to call your carrier and say, could I treat this distribution as a rollover each time it happens and transfer it to this IRA brokerage account?
Okay.
Sorry, we may not be understanding the question.
No, yeah, that's when you have an RMD, you have to take the money out. It's taxable.
Yes, correct. But I was
Yeah.
talking about you could have an annuity, like some of them might say start paying guaranteed income out at age 65.
Right.
Well, you're not of RMD age yet, right? But that annuity is paying out, but you're like, well, now I want it to stay within the IRA. Well, I don't know, right? If it's already in an IRA, you'd have to work with your carrier and say, could I treat this annual distribution as a rollover and then
Yeah.
roll it to the next IRA?
Yes. Yep. That works. All right. I think that may be all for. The long-term care question. I'm including this LTC question again, as Nancy mentioned, she was looking for it. You didn't mention possible costs associated with assisted living or nursing home care. Many people have long-term care to pay for these. I'm wondering if an annuity might be better as it provides more flexibility in what the income from the annuity could be used for. What are your thoughts?
Well, I mean, generally annuities are not more flexible. They're less flexible because you've entered a contract in terms of when that income starts and how much it's going to be. And so, and the variable annuities, as we looked at, because of the fees in those contracts, it's not necessarily true that they're going to provide more income that's inflation adjusted. And, when you're looking at long-term care, it's probably going to happen in the future where you're going to need that inflation protection. So I think annuities are designed to pay a contractually guaranteed income. And so when I run a client's plan out, where they work really well is to cover absolutely known expenses. Right? So I know, for example, let's say someone's going to spend at least $50,000 a year to cover their utilities, food, gas, basics, right? Well, great. If you have at least $50,000 a year of contractually guaranteed income coming in, that's a good match, right? That makes sense. But if I have an unknown expense like long-term care, I don't know when it's going to start. I don't know how much it's going to be. I don't know if I'm going to need in-home care or need to go somewhere. To me, that's actually not as good of a match. Now, there are hybrid long-term care annuity products that are a completely different kind of thing. And that's not the type of annuity that we're talking about. So that kind of product may be a good fit to cover long-term care costs. So I don't know if that necessarily answers your question, but those are my off the cuff thoughts.
Okay. I responded back. What is the question you're asking here? And it came back again. So here's the question. We are looking at pivoting some of our accounts with risk and place the money into annuities. It has a 10% cap for earnings and a 40% bonus added to the account, I think within 30 days. It sounds crazy too good, but I hope it's legit. 40,000 for every 100,000 is what we are looking at here.
It's much like one of the illustrations we showed earlier. Yeah. And so, yes, there's annuities that provide a bonus and all of that, but keep in mind, that's fake money, right? That's your fake money account. It's not your real money account. All that's going to be used to do is to, let me go back to this situation. So in this case, we have a, Illinois-based client. There's this income credit line that you see over here. So sometimes you'll see bonuses that get paid in when you buy an annuity. And this illustration all looks great, right? Here's what could happen. But there in that contract that you just put money in, de-risking is fine, but you need to look at what are the contractually guaranteed things that happen. All the bonuses amounts and this and that, that's all a bunch of bells and whistles. It doesn't really mean anything, right? What it means is you put this money in, and what are they contractually guaranteeing to pay out to you and when? And so anything else is, I'm going to call it like a mirage. Honestly, it is. It's a mirage. So if it sounds too good to be true, you're probably looking at all the bells and whistles. Yeah, you're probably looking at all the bells and whistles, and what you should be looking at are what are the contractually guaranteed features of that contract.
Yeah, it went on to, it's a 10-year contract, which we won't need to worry about. I'm looking at the point being made, which is it's a 40% bonus, so $40,000 for every 100,000. So if you put in 300,000, they give you 120. Nobody gives you money like that. So I would just really look at the fine print.
I mean,
carefully.
There are contracts that have like, oh, you get this bonus that comes in, but that bonus typically goes to what I call the fake money wallet number 2, and it's used to calculate your withdrawal amount one day. And so that's why you really just have to look at what the contractual guarantees are.
In what situations is it better to buy a deferred income annuity with payout starting in 10 years versus waiting 10 years and then buying an immediate annuity? Is it risk of early death, current interest rates being high?
And I think factors? It's a great question. People who bought annuities long ago that had deferred income, and when interest rates were high, right? Then we went through a 10-year period where interest rates were low. And so some of it is just a matter of timing, right? So we have implemented some deferred income annuities for clients today with the income scheduled to start in about 10 years, because when we run the illustrations today, the metrics look good, right? Mm-hmm. When we run those illustrations 5 years ago, they didn't. It didn't add any value. We don't know where interest rates are going to be 10 years from now. That's the reality. We don't know what things are going to look like 10 years from now. So if you are, I wish there was clear-cut answers to these things, right? If you are comfortable taking market risk and you're like, you know what, I'm just going to wait, and in 10 years, I'm going to run some immediate annuity quotes then, and I think I can grow my money significantly in the meantime, that is one approach. Another approach is to say, wow, let me see what's out there. If I could put 100,000 in today and have a contractual guarantee that begins in 10 years, and that's what I'm going to retire, and I could have that peace of mind, then great. But nobody knows which one's actually going to be the better of the two until we're 20 years in the future looking back.
What about purchasing an annuity through work? For example, my state government employer offers an annuity you can only purchase when you retire and start drawing your pensions. This is through Washington, state of Washington, so you even get a COLA.
So a lot of those are structured as buying years of service. Basically, you're buying additional units or years of service into an existing pension plan. And most of the time when we've done those types of an analysis, they are a good deal, but not always. And so again, without actually running the numbers and saying, well, what are they offering you? What's the cost? What's the income for life? And calculating out the internal rate of return, we don't really know. But I will say I've had many clients over the years, not many, I'm going to say every few years, we have someone that gets one of these offers that we evaluate. And most of the time they've been pretty good deals.
I think that is all the questions that means we've covered all the questions that we have. Yes, I don't know if there's anything else. There's one that I don't think that we touched on. Any and all advantages and disadvantages between commission-free advisor annuity and agent annuity?
We use both, and honestly, No. I mean, in some cases, we've found the commission advisor to be more knowledgeable and have better quality products. And so I can't really say, right, it's just going to depend on the company, what carriers they're contracted with, you know, but I can't see a significant advantage to one versus the other.
I think that's a wrap.
All
That's
right.
all the
Well, it's
questions.
been fun as always. Thank you so much, Nancy, and thank you everybody for all your questions and for attending in the middle of the day. And we appreciate your participation. Bye, everybody.